How do you make $10,000 in forex? I mean, it really is the ultimate question, isn't it? Welcome to The Explainer. I am so incredibly thrilled you're hanging out with us today because we're going to break down the exact step-by-step journey of taking a tiny trading account and scaling it up into a truly substantial portfolio. To help us visualize this whole process, we're going to follow our brave little stickman trader right here. He is starting out with just a few bucks in his pocket and, honestly, a whole lot of ambition. But as we're going to see pretty quickly, ambition alone, yeah, that's not going to protect his capital.
10 grand. It's a number that just flashes in the minds of almost every beginner the second they open up a trading app. You see the absolutely massive daily volume of the foreign exchange market. We're talking over $6.6 trillion a day, and you immediately think, man, I just need a tiny, microscopic slice of that pie. And hey, while that $10,000 goal is super exciting, the real secret to actually reaching it, it's not about finding some magical hidden trading strategy. The secret is pure survival. It's absolute discipline. You see, the market is literally designed to transfer wealth from the impatient to the patient. If you focus solely on that $10,000 finish line, you are almost definitely going to lose your initial deposit. Instead, you've got to focus on just surviving long enough to let the math actually work in your favor.
Okay, let's dive into this roadmap to scale your capital safely. First up, the small capital trap. Then, the percentage paradigm. Next, the demo training ground. Fourth, dodging the storm. And finally, the mental game.
Section 1, the small capital trap, avoiding the pitfalls.
All right, let's start with the first major hurdle for beginners. And honestly, this is where trading dreams are usually completely shattered within the very first week. So imagine our stickman starts with just a $10 account balance. It's super common to want to just test the waters with a tiny amount of cash, right? But human psychology plays a massive trick on us here. A beginner looks at that 10 bucks and thinks, well, I want to make a real profit, like at least $2 or $3 a trade to make it worth my time. But think about the math for a second. Making $2 on a $10 account means you're risking a huge portion of your capital to get it. So often, beginners end up risking 50% of their entire account on a single trade, just to feel like they're making what they consider real money. Well, if you're risking 50%, you only need 2 consecutive losing trades to completely blow up your account. And boom, the piggy bank is empty. Over-leveraging tiny accounts because you're focused on a monetary desire rather than strict risk management is absolutely the guaranteed fastest way to fail. The pro mindset? It completely ignores the dollar amount. It focuses exclusively on surviving so you can trade tomorrow. Moving right along to Section 2, the percentage paradigm. Shift your mindset. So the crucial point is this. To actually grow that small capital, we have to completely change the way we calculate our trades. We have to leave the dollars and cents behind and step fully into the world of percentages. The golden rule here, and you should probably engrave this in your brain, is to never, ever risk more than 2% of your account per trade. That massive green area you're looking at, that represents your safe capital. And your number one priority as a trader is to protect that green area at all costs. It doesn't matter if you have $10, $1,000, or $10,000, your risk needs to be a strict percentage. Look at it this way. If you have a $10,000 account, a 2% risk is $200. If you hit a losing streak, and let's be real, that happens to every single trader eventually, risking only 2% ensures that your capital draws down very, very slowly. You'd literally have to lose dozens of trades in a row to wipe out your account. By focusing on percentages instead of specific monetary values, you completely remove that desperation of trying to make a certain amount of cash just to pay a bill, and you finally align your trading with actual mathematical probabilities. But you're probably wondering, how do we actually grow it, right? Well, we use the magic of compounding, but we have to do it methodically. You should only adjust your position size after you have actually proven your consistency. A really fantastic rule of thumb here is to wait for a 30% overall increase in your capital before you even think about recalculating your trade size. Let's say our stickman starts with that small $10 account. He doesn't just start jacking up his lot sizes after one lucky winning trade. No way. He waits until his account hits $13, a solid 30% gain. Only then does he recalculate his 2% risk based on that brand new $13 baseline. This strategy builds an incredibly robust buffer. It actively prevents you from over-leveraging during a hot streak. Basically, you have to earn the right to trade larger sizes by proving you can consistently grow your baseline.
Section 3, the demo training ground. Build your skills.
Okay, but how do you prove that consistency without losing your hard-earned cash while you're still figuring things out? You step into the sandbox. A demo account provides you with virtual funds that are connected to real-time, live market data. Now, step 1 is simply getting comfortable trading those virtual funds. But step 2? This is the absolute game changer. You must execute at least 50 test trades on your demo account. Why 50? Because you need that specific repetition to learn the platform's mechanics perfectly. You need to know exactly how to execute a buy, a sell, how to set your stop loss, and how to take profit without a second of hesitation. Think about it. If you make a fat finger mistake in a demo account, you just learned a valuable lesson. But if you do it with real capital, you lose your actual money. Taking 50 test trades also lets you gather enough real data to see if your trading strategy actually has an edge in the market. Please, whatever you do, never risk a single real dime until you've proven your strategy works over a solid sample size of at least 50 trades in that demo environment.
All right, Section 4, Dodging the Storm, Macroeconomic News.
And this brilliantly illustrates our next major hurdle. Look, once you have your strategy nailed down, you might start feeling pretty invincible, thinking you're ready for anything. But external macroeconomic factors can and will absolutely destroy a small account if you're not careful. The number one tool every trader has to check before they even think about doing anything else is the economic calendar. Every single day, governments and central banks are releasing economic data. This breakdown right here shows how these events are typically color-coded. Yellow events, those are low impact. The market barely even blinks at them, so normal trading is totally fine. Orange events mean medium impact, so you definitely want to proceed with caution and maybe tighten up your risk a bit. But those red events, those are the high-impact data releases. We're talking things like the CPI, which measures inflation, or the NFP, the non-farm payrolls report, which measures U.S. employment. For a beginner playing with a small account, a red event means one thing and one thing only: do not trade. The volatility during these moments is just violently unpredictable. The market can whip hundreds of pips in a matter of literally seconds. In fact, the absolute safest play you can make for your small capital is to just sit on the sidelines. You really shouldn't be opening any new trades 5 to 15 minutes before high-impact news data is released. Here's what happens behind the scenes during these crazy high-volatility moments. Liquidity actually drops significantly, and that causes the spread, which is the gap between the buy and sell price, to widen dramatically. And honestly, even worse than that, the market can move so incredibly fast that your carefully placed stop loss just gets completely skipped over, causing you to lose way, way more than your strict 2% limit. The smartest traders out there, they know that sometimes doing absolutely nothing is the most profitable position you can possibly take. Just wait for the news to drop, let the market digest the shock, wait for a clear direction to form, and only then should you start looking for your entry.
Finally, we arrive at Section 5, the mental game, trading psychology.
We've covered the math, the strategy, dealing with market events, but honestly, none of it matters even a little bit if you can't control yourself. I want you to really, truly absorb this quote. The market doesn't care about your emotions, your journal does. When you finally make that jump and transition from that safe demo account over to real money, everything changes. In a demo account, there's no fear because there's no real loss on the line. But the very second your actual hard-earned capital is at risk, fear and greed, which are absolutely your two worst enemies in this game, they are going to grab the steering wheel. You're going to find yourself wanting to close out winning trades way too early just out of pure fear of losing the profit you see on screen. And you're going to hold on to losing trades far, far too long out of this greedy, desperate hope that they'll just magically bounce back. But the market is cold. It's calculating. It is completely indifferent to your stress. To survive this, you have to practice emotional control, and your primary weapon for doing that is your trading journal. A proper trading journal is not just some boring ledger of your profits and losses. It's basically a mirror that reflects your own behavior back at you. After every single session, our stickman needs to sit down and log these exact details to maintain his mental discipline. Obviously, you've got to record the basic math, your entry and exit points, your position size, and your exact risk level. You also need to note the market conditions. Was it trending nicely, or was it just chopping sideways? But I promise you, the most vital entry on this list is that last one, your emotional state during the trade. Were you feeling anxious? Did you just take the trade out of sheer boredom? Were you revenge trading because you just took a bad loss and wanted to make it back instantly? By logging these emotions, you are going to start to identify your own destructive patterns. You'll quickly realize that, hey, you always lose money when you trade while you're frustrated, or that you completely abandon your strategy the minute you get overconfident. Identifying and managing these emotional triggers, that is exactly how you master the mental game.
Just look at our stickman now. He's prepared, he's educated, and most importantly, he's disciplined. He finally understands that profitability is not some overnight lottery ticket. The data consistently shows us that becoming a truly profitable trader takes anywhere from 6 to 12 months of constant, dedicated effort. It takes real time to internalize that 2% rule. It takes time to learn how to survive the wild volatility of those red folder news events, and it takes serious daily dedication to journal your emotions day in and day out. Chasing a quick $10,000 is just going to lead you straight to a blown account. The real key to scaling your capital is internalizing this one undeniable fact. Discipline is the true currency of forex. If you can protect your capital today, you are literally buying yourself the opportunity to profit tomorrow. So the question really isn't whether you want to make $10,000. Everybody wants that. The real question is, are you disciplined enough to actually earn it?